Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're taking a deep dive into the Q4 and fiscal year 2025 earnings call for Evolution Petroleum, ticker EPM. That call just happened this morning, September 17th, 2025.
Yeah, and it was an interesting one.
It really was some, impressively strong financial beats on paper, but the immediate market reaction, a bit flat. Kind of surprising.
Definitely muted.
So for you, we're going to unpack these numbers, dig into management strategy, and try to figure out what might be making investors pause a bit.
Exactly. It's a bit of a paradox, isn't it? We'll really explore how EPM's, their clear capital allocation plan, their increasingly diverse commodity exposure, and this very strategic, almost defensive focus on shareholder returns played out this quarter.
And what it means going forward.
And crucially, what it signals for where they're headed next.
Absolutely. Okay, let's jump straight into those headline numbers because, honestly, they kind of defy that market shrug. Evolution Petroleum reported GAAP EPS of $0.10.
And GAAP, that's generally accepted accounting principles, standard stuff.
Right, the standard way. And that $0.10, it significantly beat analyst estimates. They were way down in the $1 to $0.02 range. Big beat there.
Huge beat. And it gets better, actually, on a non-GAAP or, adjusted basis, which often gives a cleaner look at operations by stripping out one-offs.
Right, the core performance.
Yeah, exactly. EPS came in at 0.03 cents. That also comfortably beat those same $0.01 to 0.02 estimates. So strong beats pretty much across the board on earnings per share.
Yet, here's the twist. Revenue for the quarter was $21.1 million, basically flat year over year, down just a tiny 1%.
Which was pretty much bang on with what analysts expected.
Right, so beats on earnings, revenue in line, but then adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, a key profit measure.
A really good measure of operational cash flow potential.
That showed strong growth. Hit $8.6 million. That's up a solid 7% year over year, and maybe more impressively, up 16% just from the previous quarter.
Quite a jump sequentially.
And average production for the period stood at 7,198 BOEPD.
BOEPD barrels of oil equivalent per day.
Yeah.
That lumps oil, gas, and NGLs together.
Right.
And, what's really fascinating here, like you said, is how revenue stayed flat despite the great EPS and EBITDA numbers. It's not just talk about a diversified commodity mix. This is it in action. It shows how that balance works like a hedge.
So what happened specifically?
Well, EPM basically benefited massively from higher natural gas prices offsetting lower oil and NGL's natural gas liquids. Get this. Realized natural gas prices surged 66% year over year. 66%, up to $2.76 per MCF, or 1,000 cubic feet.
Wow, okay.
So that surge provided a really meaningful cushion, as realized oil prices actually declined 20% to around $60.82 a barrel, and NGL prices dropped 12% to $25.50 per barrel.
So the gas really saved the day on the revenue front, allowing the profit numbers to shine.
Precisely. It just highlights that strategic advantage if you're not betting the farm on just one commodity.
Super clever. But, okay, despite these pretty strong beats, this smart management of the mix, the market reaction, as we said, was a dip. Shares closed down about 0.5% on the day.
Yeah, 0.55%.
It really feels like investors are saying, okay, nice quarter, but show me more.
Right. That's exactly what that muted reaction suggests. It tells us the market wants more than just one good quarter. They're looking for consistency, maybe clearer signals about the future. They're weighing the good numbers against, other factors, and maybe waiting for more proof points.
Okay, so let's unpack those strategies and operations that got them here and what management is hinting at for the future. How are they planning to build on this momentum?
Well, management themselves called fiscal 2025 a defining year for the company. They highlighted the near record production levels, which is obviously key.
Can't argue with production.
And they really doubled down on shareholder returns. Declared another $1.12 per share quarterly dividends to the start of fiscal 2026. That makes it, 48 consecutive quarterly dividends?
48 straight. That's impressive consistency.
Oh. Yeah, and the 13th in a row at that 12-cent level.
Yeah.
But maybe the bigger strategic piece here was expanding their financial flexibility.
Ah, the credit facility.
Exactly. They amended and restated their senior secured reserve-based credit facility, the RBL. They set up an initial $65 million borrowing base, but it's under a much larger $200 million revolving credit line that matures out in 2028.
So plenty of dry powder, as they say. Capital ready to go.
Significant dry powder. Ready for opportunities. which fits right into their acquisition story.
Speaking of which, they made some key portfolio moves, didn't they? Back in April, they closed that $9 million Tex-Mex non-operated deal.
Right, adding about 440 net BOEPD. Stable, low decline stuff. Good mix, too. Roughly 60% ale, 40% gas, bolstering that diversification.
Okay, and then something bigger happened after the quarter ended.
Yeah, their largest minerals-only acquisition ever. A roughly $17 million deal in the Scoop Stack plays in Oklahoma, big producing region.
Scoop Stack, right. What did that bring in?
Added about 5,500 net royalty acres and around 420 net BOE'd at the time of the deal. And the CEO really hammered this point. It's high margin, no lifting cost income because they're just collecting royalties on the minerals.
Ah, okay, so they don't have the day-to-day operational costs on those barrels.
Exactly. They get a cut of the production without the CapEx headache or the LOE lease operating expenses of running the wells themselves. It's central to that capital light approach they keep talking about. High reward, much lower direct operational risk. You can see why those deals are attractive for them right now.
That difference between owning minerals and actually operating the wells is, yeah, really key to understanding their model. Now, on the operational side, where they are operating, any hiccups? Or is it all smooth sailing?
A bit of a mixed bag, actually. Good news first. 4 wells over at Chaveroo came online successfully, came in under budget and ahead of schedule. You love to see that kind of execution.
Definitely.
But they did have some downtime at their Delhi field. Partly safety upgrades for the facility, and partly just the summer heat limiting CO2 injection.
Right, the CO2 enhanced oil recovery process needs specific conditions.
Yeah, high temps can be an issue. So that hit volumes a bit. And then over at Jonah, sales volumes were lower because of pipeline balancing issues, but management said those are just deferred volumes. They expect to sell that makeup gas in Q1 fiscal 26.
Okay, so more of a timing thing at Jonah, not lost production.
Seems like it, yeah.
All right, so some operational bumps, but nothing seems like a major long-term issue. Now, guidance. Interesting, they didn't give formal numbers for fiscal 26. They just kind of reiterated the strategy. Selective, returns-focused deals.
Right. Pace development tied to prices, hedging.
Does that lack of hard numbers feel like maybe caution or confidence in the strategy itself?
I think it leans towards caution, honestly,
Right.
a very opportunistic stance. And what they said in the Q&A afterwards really backs this up. It gives a clearer view of their spending plans.
Okay, what did they say about CapEx?
Fiscal year 26 capital expenditures.
Yeah.
They're projecting maybe $4 to $6 million, mostly focused on integrating that Scope Stack acquisition and just general maintenance.
So not a huge spend.
No, and here's the kicker. No capital currently budgeted for new drilling at Chaveroo. That decision is totally dependent on what their partners do and, crucially, on higher oil prices. They specifically mentioned needing prices above the low $60.
Wow. Okay, so really disciplined on price.
Yeah.
Not drilling just for the sake of drilling.
Exactly. It underscores that price-sensitive approach. They're not chasing volume growth if the returns aren't there.
Makes sense in this environment. What about operating costs, the LOE? Any good news there?
Yeah, actually, they expect at least a 10% drop in LOE per barrel equivalent from Scoop Stack now that those mineral interests are fully integrated. Because, again, minerals don't have lifting costs for EPM.
Right, that flows straight through.
And Barnett LOE should also be a bit lower than the previous $18.50 per barrel. Sounds like they got some benefits from audits and renegotiated some gathering contracts. So yes, finding efficiencies.
Good. And acquisitions. Still opportunistic.
Very much so. The CEO basically said they'll chase either working interests, where they operate, or minerals, depending entirely on what deal looks like it adds the most cash flow per share. Purely about accretion and value, not locking into one asset type. Flexibility is key.
Okay, so we've covered the solid earnings beats, the smart acquisitions, the discipline on spending, but still, that quiet market reaction. Let's zoom out. What's the broader context? What big market trends did management talk about that shape their outlook?
Yeah, they gave a pretty thorough macro view, which definitely helps explain their, let's call it, cautious optimism. On oil, they see demand growth continuing that trend of the last decade, just over 1% per year, pretty steady.
Okay, stable demand.
But the supply side is tricky. OPEC Plus is adding barrels back to the market. And speculators, the financial players, are holding some of their shortest net positions in years, meaning not many are betting on prices going up right now.
Interesting.
And fascinatingly, they pointed out how little geopolitical risk seems to be priced into the forward curves, even though you can see potential flashpoints globally.
All right, seems like the market's ignoring some potential disruptions.
Could be. Management's view is if oil prices hang around in the 60s, you're likely to see producers pull back. They noted many U.S. companies are already cutting CapEx budgets.
So supply could tighten naturally if prices stay low.
That's the thinking. They even floated the idea of a potential sharp snapback in prices. Remember 2021? WTI averaged $68, then boom, surged to $95 in 2022. They think something similar could happen if demand holds up and the market suddenly needs more U.S. oil that isn't being drilled right now.
A sharp snapback. That's pretty bold given where things are. How are they positioning for that, or are they just observing?
I think it's more about positioning for the possibility, the optionality. They aren't explicitly betting the company on it happening tomorrow, but by keeping that balance sheet strong, keeping that dry powder.
They can pounce if it happens.
Exactly. They can react quickly if prices justify more activity or acquisitions rather than being forced to drill into a weak market like maybe some peers might be.
Okay. What about natural gas?
Gas looks stronger, fundamentally. The forward demand curve is pretty robust. You've got more LNG export capacity coming online, shipping gas overseas, plus more industrial demand from data centers, AI, crypto mining. All need power.
Right, those energy hogs.
Historically, producers needed Henry Hub gas prices, the main U.S. benchmark above $3.50, to really incentivize enough drilling to meet that kind of growing demand.
We're not there consistently right now.
No. And the big wild card always is weather. A warm winter or cool summer can crush near-term gas prices, no matter the long-term demand story. Huge, unpredictable swings.
So, complex picture. Steady oil demand but iffy supply response, strong underlying gas demand but needs higher prices, and weather messing with everything.
Pretty much sums it up. And that complexity likely feeds into why investors, despite the good quarter, are maybe waiting for sustained higher oil, waiting to see cash flow proof from the new assets.
It really shows that good numbers aren't always enough in isolation. Context is everything.
Absolutely. And a long-term story EPM is telling. It's clear. They're moving beyond being just the Delhi CO2 company. They're building this diversified portfolio focused on cash flow, royalties, non-op interests.
Compounding value.
Aiming for durable dividends plus opportunistic growth. That's the goal.
So, near term, what should people be watching for? What are the catalysts?
Okay, key things. First, how much cash flow those new scoop stack minerals start generating right away. Second, how well the Chaveroo wells perform compared to expectations, the type curves. Third, any new acquisitions they make using that expanded credit line.
More deals?
Fourth, obviously, just where oil and gas prices go that affects their margins and mix. And fifth, just keep watching that dividend. The next one's due September 30th. That consistency is core to their story. All these things will really shape their per share value over the next few quarters.
Got it. Okay, let's shift gears. It's time for our not financial advice segment. Purely hypothetical, maybe a little outrageous, just exploring ideas based on what we've discussed. Remember, folks, this is strictly for entertainment. Conceptual fun, definitely not a recommendation.
Right. So thinking about EPM, their disciplined approach, that capital-light expansion, strong balance sheet, lots of dry powder, and management's own comment about a potential sharp snapback in oil.
Okay, where are you going with this?
How about this? The defensive optionality play. Right now they're playing defense, right? Holding off drilling, buying those low-cost minerals, hedging. It makes them pretty resilient if markets stay volatile or even turn down.
Okay, sounds sensible. Where's the outrageous part?
The outrageous part is betting on the upside optionality the market might be missing, that $200 million credit line. That's serious firepower ready to go if, say, oil does snap back.
Yeah.
Or if great acquisition deals pop up in a downturn. The market might be overlooking how quickly they could accelerate.
Okay. So how would you structure that hypothetical trade?
How about this? Consider a long position in EPM out-of-the-money call options, maybe 6 to 9 months out. Give it some time. Pair that with a short position in a smaller, much more highly leveraged E&P peer.
Ah, a pairs trade. Shorting someone who needs high oil prices.
Exactly. Pick a company with lots of debt, one that's already had to slash spending, whose whole plan relies on oil being much higher than $60, $70.
Interesting. Creates an asymmetric bet, you're saying.
Totally. The thinking is, EPM's defensive nature, their dividend, their low-cost assets provide a downside buffer. If oil stays low or dips, EPM likely holds up better than that highly leveraged peer you're shorting.
Okay, protects the downside.
But if oil does surge, EPM has the cash and the flexibility to potentially acquire assets on the cheap or ramp up activity faster than expected, leading to a significant re-rating. faster perhaps than the financially strapped peer can react. That could really boost the value of those call options.
So you benefit if things stay weak and potentially benefit more if things rocket higher. Betting on EPM's strategic agility.
That's the idea. It's a bet on their defensive posture providing a floor, while their financial flexibility offers potentially underappreciated explosive upside. Outrageous, maybe. Plausible, given their setup, maybe.
Definitely food for thought. Okay, so let's recap this deep dive on Evolution Petroleum. A really strong quarter, fundamentally EPS adjust, EBITDA, both looked good.
Yeah, driven by those smart capital-light acquisitions and a clear, consistent focus on returning cash to shareholders.
Their diversified approach, that discipline on spending, and the strong balance sheet seem to put them in a pretty good spot to handle volatile energy market.
Absolutely. Multiple catalysts lined up too, the new assets kicking in, potential M&A using that credit line, all aimed at steadily growing that per-share value.
So while the market might have given a bit of a shrug initially, the underlying story seems solid. Strategic execution, financial common sense, and, as you put it, that built-in optionality for growth.
Indeed. And it leaves you wondering, right, in today's energy market, maybe that consistent, patient value creation, backed by real flexibility, is actually being undervalued by the focus on short-term swings.
Perhaps that quiet market reaction is exactly where some people see the long-term opportunity. A great final thought. Thank you for joining us for this in-depth deep dive into Evolution Petroleum's latest earnings call. Definitely encourage you to keep exploring these themes.
And just a reminder, everything we discussed today is purely for informational purposes. It's absolutely not financial advice.
We really appreciate you tuning in to the deep dive.